Most people in crypto assume that hedge funds and institutional investors play by the same rules as retail traders. They don't. While retail investors chase pumps, buy into hype, and hold too long, hedge funds are strategically entering and exiting positions with one goal in mind: profit. They don't fall for emotional narratives. They don't hold out for loyalty to a coin. They follow a playbook designed to maximize gains and minimize risk in both bull and bear markets. The question is, what are they doing right now? So today I'm going to break down exactly how smart money is moving in this bull market, what hedge funds are doing differently than retail traders, and most importantly, how you can position yourself alongside them instead of being their exit liquidity. So let's start with the most important difference between institutions and retail. It's profit taking. The biggest mistake retail traders make in every bull market is holding too long. They get caught up in the euphoria, believing prices will go up forever. They watch their portfolio grow by 5x or 10x, but instead of securing profits, they convince themselves that this time is different. Institutions don't think this way. They don't fall in love with their holdings. When they see massive gains, they take profits gradually, not all at once, but in structured sell-offs designed to offload risk without crashing the market. This is why smart money sells into strength while retail buys at the top. In 2021, on-chain data showed that long-term Bitcoin holders were selling heavily when Bitcoin was above $60,000, even as retail traders were buying the most they had all year. Institutions were taking profits. Retail was FOMOing in. A few months later, Bitcoin was back under $20,000 and retail was left holding the bags. So what's happening right now? What does on-chain data tell us about smart money behavior in this cycle? One of the biggest indicators to watch is exchange inflows and outflows. When large investors are accumulating, Bitcoin tends to flow off exchanges and into cold storage. This means they're preparing to hold long term. But when large amounts of Bitcoin start moving onto exchanges, that's often a sign that institutions are getting ready to take profit. Right now, we're seeing mixed signals. Bitcoin ETFs are still absorbing large amounts of Bitcoin, which suggests institutional demand is strong. But we're also seeing higher exchange inflows from long-term holders. Another key indicator is futures open interest and funding rates. Hedge funds love to use leverage and derivatives to control risk and amplify returns. When funding rates get extremely high, it usually means the market is over-leveraged and due for a correction. We saw this exact pattern in 2021, right before the May crash that wiped out billions in leveraged positions. So, how does this apply to you? If you're seeing extreme leverage with traders going all in on long positions, it's a signal that the market might be due for a pullback, downward price. Another strategy that hedge funds use is sector rotation. Retail traders tend to hold onto their favorite altcoins no matter what, but institutions are constantly shifting their capital into the strongest sectors at any given time. In 2017, it was ICOs. In 2021, it was DeFi and NFTs. Right now, it's layer 2 scaling solutions, AI tokens, and real-world assets. Hedge funds don't just blindly hold, they move their money into whatever sector is gaining the most liquidity. This is why smart investors don't marry their bags. If a sector is slowing down and another is gaining momentum, they rotate profits accordingly. Another key hedge fund strategy is shorting the market. Most retail investors only think about making money when prices go up. Institutions play both sides. When they see a market that's overextended, they hedge their bets by shorting. Now, this is exactly what happened in 2022. When the bull market ended, hedge funds weren't just sitting on the sidelines, they were shorting over-leveraged projects, betting against unsustainable business models, and making money while retail investors were losing everything. This is why it's so important to watch funding rates and open interest. If institutions start aggressively shorting the market, it means they expect a downturn. So, how can you apply these strategies as a retail investor? Well, first, Take profits when the market is strong. Don't assume prices will always go up. If you're sitting on major gains, start scaling out instead of holding everything until it's too late. Second, pay attention to on chain data. If long term holders are sending Bitcoin to exchanges, that's a warning sign. If leverage in the system is getting too high, that's a risk factor for a liquidation event. Third, be flexible. Don't fall in love with your bags. If one sector is losing momentum while another is gaining, consider rotating into stronger opportunities. But try not to chase the trend. The best investors adapt rather than holding onto outdated narratives. Fourth, understand that institutions are playing a different game. They are not in crypto for the ideology. They're here to make money, and they will take advantage of retail traders who refuse to think critically about their investments. So what's the takeaway? Hedge funds and institutional investors are not emotional traders. They are systematic, disciplined, and profit-driven. They take profits when retail buys the top. They hedge against downturns while retail panic sells at the bottom. The key to surviving in this market is learning from them instead of being their exit liquidity. So I want to hear from you. Do you think smart money is already preparing to take profits in this cycle? Have you adjusted your strategy to follow institutional trends? Or are you still holding like retail? Drop your thoughts in the comments down below. And if you want to learn more about how to navigate crypto with a professional mindset, check out learningcrypto.com. It's the best place to get real, practical crypto education. Thanks for watching. I'll see you in the next video.